Grupo Cibest, ticker CIB, delivered a massive double beat this morning. I mean, they reported an EPS of $3.32 per ADR, which is coming in like 55.14% above the Wall Street consensus of $2.14.
Yeah, that is a huge beat.
Right. And net income hit 2.73 trillion Colombian pesos. That's up 87.38% sequentially and 52.42% year over year.
Driven mostly by net interest income, which cleared 6.04 trillion pesos.
Exactly. And forward guidance is just as aggressive. Management raised full-year ROE targets to a range of 21% to 22% and bumped net interest margin guidance to, between 7.4% and 7.6%.
Which is pretty wild given the environment.
Yeah, loan growth targets were held firm at 7% to 8%, with the efficiency ratio projected at roughly 48%. And the stock opened up 3.1% and $91.63, though it spent the rest of the session like chopping around the high 90s.
Well, that intraday chop makes perfect sense when you look at a longer time horizon. I mean, a 3% bump on a 55% earnings surprise seems kind of muted, but CIB has run up roughly 90% over the trailing 12 months.
Right, so they already had a massive run.
Exactly. Institutional money had already priced in a flawless quarter. The market demanded perfection just to justify the current multiple, and management, well, they actually managed to clear that incredibly high bar.
Okay, let's unpack this, because the numbers are undeniably strong, but digging into the mechanics of how they achieved a 2.73 trillion peso net income in this specific environment, it presents a real contradiction. I mean, they expanded their NIM by 91 basis points quarter over quarter, pushing it to 7.94%.
Yeah, a huge jump.
Right, and we know that's being driven by the central bank's policy rate, which is currently sitting at a punishing 12.75%. So I have to push back on the traditional logic here. Usually, maintaining a 13% benchmark rate operates like a casino suddenly pushing the house edge to 20%.
Right, the house always wins until people stop playing.
Exactly. The margins look incredible on paper for a few weeks, but eventually the gamblers just go broke, the volume disappears, and the house takes a hit.
How is Grupo Cibest expanding margins so aggressively without, drowning in a wave of defaults from borrowers who simply can't service 13% debt? You're hitting on the core tension of emerging market banking right now. The short answer is that they've fundamentally rewired their profit engine to rely less on the traditional borrower.
Oh, really? How so?
Well, they are certainly capturing the upside of floating rate commercial loans repricing higher. But the real heavyweight driver this quarter was a massive surge in Treasury and investment income. They leaned heavily into the carry trade and government securities.
So they are effectively utilizing their massive deposit base, like the low-cost capital sitting in everyday checking and savings accounts and rotating those funds into high-yielding sovereign bonds.
Yes, exactly.
They are stepping over the consumer entirely to capture that spread directly from the government.
That is the exact mechanism, yeah. They are hedging the inherent default risk of a 12.75% rate environment by substituting consumer credit risk with sovereign credit risk. And it's a structural advantage they've modeled out extensively. Plus, Goldman Sachs economists are currently projecting that the Colombian Central Bank won't initiate rate cuts until the third quarter of 2027. So we're looking at a sustained higher for longer environment.
And even when those cuts do materialize, management sensitivity analysis shows they are heavily insulated, right? I mean, the guidance explicitly stated that for every 100 basis points the policy rate drops, their NIM only compresses by about 20 basis points.
Right, because they've locked in duration on the investment side while maintaining elasticity on the deposit side. It is literally a masterclass in asset liability management.
Wow.
But, your earlier skepticism about borrower health is still the most critical vulnerability for any financial institution. We have to examine the actual loan portfolio to see if the underlying credit quality is degrading.
Yeah, and that's where the data gets truly surprising. You'd expect massive degradation, but the annualized cost of credit actually dropped by 0.34 percentage points to 1.56%.
It was totally counterintuitive.
Completely. And net provisions fell 16.75% to 1.02 trillion pesos. The company cited significant client recoveries as the primary driver there, but even the core non-performing loan metrics are remarkably stable.
Yeah, the 30-day NPLs are sitting at 3.59%, and the 90-day NPLs are at 2.48%.
Right.
And we shouldn't overlook the allowance coverage either. They are sitting on 132.94% coverage for those 30-day NPLs. That is an incredibly conservative capital buffer for a gross loan portfolio of 262.3 trillion pesos.
That's a massive portfolio.
It is. It signals that management is fully aware of the macro fragility and refuses to get caught under-provisioned.
Well, speaking of that total loan portfolio size, there's a glaring metric in the report that requires some parsing. The headline loan growth was essentially flat, like up a microscopic 0.17% quarter over quarter.
Yeah, it looks pretty bad on paper.
Right. On a superficial read, that looks like loan origination has completely stalled out. But crunching the currency metrics, I think we are looking at a massive FX illusion here.
The currency swings are huge.
Exactly. The Colombian peso appreciated 15.5% year over year and 6% in this quarter alone against the US dollar. And since Grupo Cibest has a significant regional footprint in places like Panama and El Salvador, they originate a massive volume of dollar-denominated loans.
Right, those dollarized economies.
Yeah, so if I'm modeling this correctly, the stronger peso is just shrinking the translational value of those foreign loans on the consolidated balance sheet. So it makes it look like growth has stalled when local origination might actually be accelerating.
Your model is spot on. This is a perpetual hurdle when analyzing multinational Latin American equities.
Right.
When the home currency flexes that hard, a 15.5% appreciation is a violent move in FX market.
Yeah, it's huge.
Every single dollar-denominated mortgage in Panama and every commercial loan in El Salvador suddenly translates into significantly fewer pesos. So the headline figure shows 0.17% growth, but that completely obscures the underlying operational momentum.
Right. The actual volume of localized lending is robust. It's simply being masked by the accounting translation back into a hyper-strong peso.
Exactly. It's a prime example of why you can't just scrape the headline numbers on international banks.
Here's where it gets really interesting, though. This regional footprint brings up the broader structural evolution of this company. We need to talk about the 28.73% quarterly annualized ROE.
Yeah, that's an eye-popping number.
You do not generate nearly 29% returns on equity by just being a traditional legacy lender, taking in deposits and writing mortgages. This goes back to the corporate transformation a year ago when Bancolombia reorganized into the Grupo Cibest holding conglomerate.
Right, that restructuring was the catalyst for everything we are seeing today. Management stopped operating like legacy bankers and started operating like ruthless portfolio managers. They're actively trimming maturity, reallocating capital, and identifying stranded value within their own subsidiaries.
And the most glaring evidence of that portfolio management strategy is the Banismo divestiture.
The Panama sale.
Yes. They closed the sale of their Panamanian subsidiary on June 30th to Banco La Hipotecaria for $1.418 billion. That is a colossal liquidity event. More importantly, it severs all governance and board ties with Inversiones Cuscatlán. They carved out a mature, capital-intensive asset, secured a premium valuation, and instantly simplified the conglomerate's org chart.
Simplifying the org chart while simultaneously injecting $1.4 billion in fresh liquidity. So the immediate question for institutional investors was, how management planned to deploy that capital.
Right. What do you do with $1 billion?
Exactly. And we got the answer in this print, a 1.35 trillion peso share buyback program. They are utilizing the divestiture proceeds to forcefully reduce the float and consolidate ownership.
Which further artificially boosts that EPS number we saw in the headline.
Precisely.
Buybacks and divestitures are classic private equity maneuvers. But the real structural upside, like the piece that could drastically alter the valuation multiple of this entire holding company, is what's happening on the digital front.
Oh, absolutely. The digital scale is staggering.
Yeah. The traditional Mi Bancolombia app has 9.5 million active users, which is solid. But Niki, their digital wallet, is operating on an entirely different scale. We are talking about 28.8 million accounts, with 23.5 million classified as highly active.
Let's put that scale into perspective for a second. The entire population of Colombia is roughly 52 million people.
Right.
Niki has essentially captured half of the nation's populace. That level of market penetration transitions a platform from a banking app into core national financial infrastructure.
And the strategic play here is the impending spinoff of Niki. Right now, it's a high-growth fintech asset trapped inside a traditional bank's balance sheet. It's like finding a hyper-scaling software startup buried in the basement of a legacy lumber company.
That's a great analogy.
Right. As long as it sits in the basement, Wall Street values the entire enterprise based on the price of lumber. By spinning Niki off into its own standalone entity under the Grupo Cibest umbrella, they forced the market to assign it a technology valuation multiple rather than a legacy banking multiple.
It's the ultimate value unlock. Yeah. I mean, legacy banks typically trade at somewhere between 1 to maybe 2 times book value if they're lucky.
Yeah.
But high-margin fintech platforms with monopolistic market share, they trade on massive revenue multiples. The spinoff isolates the growth engine from the regulatory capital burdens of the core bank.
So management is engineering a scenario where the sum of the parts is drastically more valuable than the current consolidated whole.
Exactly.
All of this paints a picture of a perfectly optimized financial machine. They are printing money on the carry trade, their credit quality is rock solid, they are successfully rotating capital out of mature assets, and they're sitting on a fintech golden goose.
That all sounds perfect, right?
Right. Yet the stock is chopping around the high 90s, and there is still active short interest. We have to look at the other side of the trade. What is the fundamental bear case that is keeping buyers on the sidelines?
Well, the bears are looking strictly at the macroeconomic reality on the ground, and it is undeniably grim. The Colombian economy is essentially grinding to a halt.
How bad is it?
GDP growth for the year is projected at an anemic 2.6%, while inflation continues to run hot at 6.4%. You have a classic stagflationary environment. It is incredibly difficult for any financial institution, no matter how well managed, to continually expand a loan book and grow core banking revenues when the broader economy is contracting in real terms.
And that sluggish macro picture is compounded by sovereign fiscal risk. We saw this materialize just last quarter. Grupo Cibest took a brutal 374 billion peso hit to their Q1 earnings due to a one-off wealth tax accrual.
Yeah, that was a really tough hit.
And that was enacted under a temporary government decree. Operating in an emerging market means accepting the reality that the government can simply stroke a pen and wipe out hundreds of millions of dollars in net income to plug a hole in the national budget.
That fiscal vulnerability is precisely why institutional capital often demands a steep risk premium or a lower valuation multiple to hold Latin American equities.
Makes sense.
Yeah, the threat of sudden unmodeled taxation or regulatory shifts creates a ceiling on how high the stock can run, regardless of how pristine the balance sheet looks.
Despite those very real macro and fiscal headwinds, though, Wall Street analysts are aggressively recalibrating their models to the upside. JP Morgan just upgraded the stock to overweight.
Yeah, and Boca Securities upgraded them too.
Right. BofA upgraded them from underperform to neutral, pushing their price target from $68 up to $75. And I want to highlight the specific rationale BofA cited here, and I'll note for you listening, we strictly report analyst modeling logic here without taking any political stance ourselves.
Of course.
BofA explicitly pointed to reduced country and political risk following the strong electoral performance of a market-friendly candidate, Abelardo de la Espriella. Analysts are actively pricing that political shift into their valuation models as a tangible risk reduction metric.
It really illustrates how heavily sovereign politics weigh on emerging market valuations. A perceived shift toward market-friendly governance immediately compresses the risk premium analysts apply to the stock. But even if you strip away the political forecasting, the institutional pivot back toward Grupo Cibest is anchored by the fundamental floor management has built under the stock price.
You're talking about the capital return program.
Yes. When you navigate a stagflationary environment with constant fiscal noise, investors need downside protection. The current dividend yield is estimating out somewhere between 5.23% and 6.25%, depending on how you model the forward distributions.
Cup a reliable 6% yield with a 1.35 trillion peso buyback aggressively soaking up the float, and you have a very compelling thesis for the retail investor. The company is essentially paying you a premium yield to hold a highly optimized, dominant asset while you wait out a difficult economic cycle.
It completely shifts the holding psychology. You aren't relying solely on capital appreciation in a 2.6% GDP growth environment. You are compounding a 6% yield while management structurally increases your ownership stake through the buybacks, all while waiting for the Nikkei spinoff to catalyze a multiple expansion.
Which leaves us with the ultimate question regarding this quarter's performance. Grupo Cibest just generated a towering 28.7% ROE, executed a billion-dollar strategic divestiture, and printed record net income, all while operating in a stagnant, low-growth economy weighed down by punishing 12.75% interest rates.
Right.
What is this highly optimized financial machine capable of generating if the Colombian macro environment actually pivots into a high-growth expansion cycle? Something to think about.
Yeah.
Make sure you follow the show for your daily deep dives into the earnings that matter.